Everybody wants to be a millionaire, but no one wants to do the hard work. So in today's video, we're going to talk about dividend investing and how reinvesting those dividends is going to get you rich. I'm sorry to tell you right now, there are no shortcuts in life, and this is not the video for you if you think you're going to get rich overnight by investing in some kind of penny stock. But let's start out with this, right? We all aspire to get rich, and even if you don't want to be rich as Jeff Bezos, riding an oddly shaped spaceship into the stratosphere, most people at their very least want to have a comfortable retirement. And to me, this makes sense. Why would you want to retire and then go to work for another day when you don't have to? I know for a fact that I don't. Now, the issue is most Americans are not ready for retirement when they consider their finances. According to Yahoo Finance, 64% of Americans aren't prepared for retirement, and even more concerningly, 45% don't care. Yeah, you heard me. They don't care that they're not going to be able to retire with their own money. And I'm pretty sure those are the same people at the Gucci store blowing their stimulus check back during the pandemic, or in a bag, or at Chipotle buying extra guac. Nothing wrong with extra guac, but come on guys, what's wrong with you? Now, let's drill a bit deeper into the data here, right? 45% of respondents in this survey didn't have any money put aside for retirement, while 19% said they'll retire less than $10,000 to their name. 20% said they're going to retire with anywhere between $10,000 to $100,000. And please be mindful that $100,000 is not going to be anywhere near enough to live off in retirement. Let's say you retire at 65 years old and you have $100,000 in your retirement account. If you lived for another 25 years, you might be able to, and I say might because that money's probably invested in the stock market, you might be able to pull out $4,000 from the account on a yearly basis. If you're lucky, you might get $30,000 yearly from the government through your Social Security income, if that still exists 30 years from now, which I doubt. And sure, you can live off maybe $34,000 a year, but you're not going on that vacation to Europe. You're not going to be buying grandkids nice things for Christmas. If you have any debt at that point, it's game over. To me, this is not acceptable, and I think you deserve better. So the goal of this video is to explain what is DRIP, or the Dividend Reinvestment Plan. And by providing you some basic facts about this style of investing, I hope to inspire you to start taking the actions today needed to control your financial future. Now with that, let's get into the details. To start off, I want to discuss inflation, and I know it's a deadly word with the whole rate hikes and Federal Reserve and can't go to the grocery store because bread costs $10. It's like we're back in Weimar Germany, right? But to frame it, when the pandemic began, governments around the globe took tremendous efforts to stave off the economic consequences of the pandemic and the lockdowns that it caused. By printing money, this is a subject for another time because the Federal Reserve isn't actually printing money, it's buying assets with what I can denote as Chuck E. Cheese tokens. The government had backstopped the economy from a downward spiral. And unfortunately, the economy isn't like a computer. You can't just turn it off and on again. It doesn't really work out too well. Now, Republicans claim that the high inflation, over 9% last year, is caused by the federal government spending under the Biden administration and the Democratic majority in Congress. Now, on the other hand, Democrats claim that inflation is transitory, it's going to ultimately benefit workers due to higher wages down the line, and this is primarily caused by supply chain issues and other transient factors. Candidly, I don't care what either side says, and whatever your political views are, here is the fact. Inflation is here. Whether or not it's transitory does not matter because it is impacting you, your ability to save, and most importantly, your ability to retire comfortably. And if inflation is high and it reduces your ability to retain your purchasing power over time, then you need to know how to beat it. And this is where investing comes into play. If inflation is a deadly word, investing is a solution to that word, which is going to happen in the same time as the first letter. Now, I want to talk about investing and why does it matter and why you should, begin to think about this in your life, right? This section is short because everyone and their mom has gotten into investing since the pandemic started, right? Maybe a little bit less now with the bear market that we went through at the end of 2022. We're still technically in one, but that's a topic for another conversation. But, just to frame it back into the pandemic, because I think that's a really good grounding point for a lot of these topics. The lockdown happened, you got a stimulus check, you didn't have a lot to do. So people got involved in the casino known colloquially as Wall Street. And the issue is that many people haven't taken the time to train themselves or be trained in technical analysis and fundamental analysis so they can make good decisions when investing in the stock market. And again, these are topics for another point in time, but I want to stress that investing is easy when the market is doing well. When there are low rates, cash flowing out from the government and into businesses' hands like water does out of a faucet, it's pretty easy to keep the train moving. Now, the issue is these factors have gone away, and as the economy continues to recover and stocks resume their normal protocol, stocks aren't going to go up in a straight line. As we saw during 2022, they essentially fell off a cliff, especially a lot of the big growth names that people got invested into in 2021. Now, I can't project into the future about the direction of the stock market, but what I will say is that investing for the long term has many benefits that you should be aware of. Having savings in today's economy is not enough before low record interest rates, but you could even argue that a 5% Fed funds rate is low in comparison to the similarly inflationary period of the 1980s. The money that you can get out of your savings account is going to be less than inflation, and in terms of things that you can buy, you're going to lose money over time. Investing has the benefit of compounding, the eighth wonder of the world that Albert Einstein mentioned in interviews back in his time. Compounding occurs when an investment generates earnings which are then reinvested. These earnings create their own earnings, and if given enough time, they can radically improve the outcome of companies that you invest in. Now, to manage your investment goals, you need to figure out when you'll need the money and what your time horizon is for your investments. If you're young and just starting out of college, every dollar invested can mean the difference between a good and decent retirement. Just make sure that you're paying down that high interest debt if you have any, and make sure you take reasonable risks. Sure, investing into a hot stock like GameStop may make you money in the short term, but short squeezes may not be the best move given their volatility and unpredictable returns. But if you're older and have a lot less time to invest compared to a 18-year-old, you're going to need to be more conservative with your investments while making sure that you have some risk assets to make sure you keep your money working for you. You can, as an example, consider things like TLT, a Treasury ETF, MUB, a municipal bond ETF, and HYG, a corporate bond ETF as alternatives. And of course, you need to talk to a financial advisor to help you ensure that you reach your goals in the most tax and performance-based efficient manner possible. But at the very least, you need to make sure you max out your employer contribution to your retirement account. If you even get a 5% match in your plan and you invest 5% monthly into your 5% of your monthly income into the account, you're basically getting an initial 100% return on your capital before it even starts growing. Now, to not use this feature of your account would be foolish, and you'd be leaving a lot of money on the table if you don't do this. Now, if you're still with me, I think I've convinced you about investing into the markets, and I think that's a wonderful thing. But we need to get into the bread and butter of this video, and that's about dividends and drip-styled investments. A dividend, for those who don't know, is a distribution of a company's earnings to a class of its shareholders, and the amount to be paid is determined by the company's board of directors. Many publicly listed companies in the US pay a dividend, and the ones that do not, like Tesla, can still be good investments, but they just may not be profitable companies yet. Announcements of dividends are usually accompanied by a proportional increase or decrease in the company's stock price because they reflect the strength of the business and that cash not being used to reinvest in the business. A DRIP or a dividend reinvestment plan is where dividends earned through an investor's stock are reinvested and immediately used to purchase more stock, making the investment in the company grow little by little without the stock price even changing. Though many brokers have a feature called DRIP, where this can be done automatically for you when you get a dividend from a company, and certain companies distributing these distributions may even give a discount on the shares reinvested if you sign up through your broker. As an example, Fidelity, one of my favorite brokers, it's the one that I use all the time, offers a DRIP feature to invest with. And depending on your experience in the market and willingness to learn about the other places to invest in, I have a lot of articles on my website, Rags to Riches, about my favorite brokers, and I think it's worth your time to review in more detail. I'll leave the link to it in the comment section down below. Now, the benefit of a DRIP plan is multifaceted, but here are some of the most important ones. DRIPs can give you discounted prices for your shares. It automatically grows the size of your investment without any additional capital being added to the portfolio. More dividends reinvested means higher dividend payouts because the underlying assets can have a larger value. Of course, you're using dollar cost averaging, which is so many separate topics, but this is a separate topic to average out the price of your purchases over time. And the best one, and I think this is really just straightforward, it's an unemotional way to invest your cash. I think when people start getting into the stock market and they start doing trades, they get all hung up on their favorite stock and why they think it's going up and why they think it's going to go to the moon and they're going to get rich from that one investment. But when you take a long-term view about investing, it becomes much more methodical, like a surgeon is approaching, doing what they do. Now, dividend reinvestment plans are not all sunshine and rainbows though, and even if you don't have to sell the underlying asset when you're getting dividends from, there are costs associated with getting a dividend. These include, and are not limited to taxation. When you receive a dividend, it's typically considered taxable income, which can be up to 20% of 20% of the value of the dividend, depending on the state and nationality that you are investing in. You need to talk to a tax advisor to discuss more details about this, because I certainly am not one. But one point of advice that I can say is, if you are planning on investing in a dividend account, you may want to consider investing in it through a Roth IRA. These are tax deferred investment accounts similar to a 401k, where when you actually get a dividend and ultimately distribute from the account, you don't have to pay taxes on it. So it's one way to limit the tax drag that you might get if you're a dividend investor. Now, over the long term, with enough time, the dividends reinvested in a company could unfortunately accumulate a large amount of a particular asset, which is going to reduce your portfolio's diversification. The issue with not diversifying is that you don't mitigate risk when one sector of the economy is not doing well, whereas other sectors of the economy would be doing well. By maybe on a quarterly basis rebalancing the portfolio or selling down assets that have gone up a little bit too much, buying more that's gone down a little bit too much, you can have spread out, diversified assets in multiple industries, and you can ensure your portfolio over the long term can sustain down periods in the market. Really simple example of this is, tech is kind of fallen off a cliff recently, where consumer staples like, you think Walmart and Dollar Tree are holding up pretty well. So you want to, on a reasonable basis, ensure that your assets are spread across multiple sectors, just to make sure you benefit from the entirety of the market. The biggest allure of a DRIP plan, in my perspective, is compounding returns. An analysis from Hartford Funds found that 78% of the S&P 500 going back to 1978 can be attributed to dividend reinvestment and their resulting compound returns. If you only invest in growth stocks and never reinvest your dividends, you're leaving money on the table, and I don't want you to do that. So unless you need the cash or plan for living off your dividends before retirement, you should try to reinvest them. Now, I hope you enjoyed this video. If you made it with me so far, be sure to like, share, and subscribe to the channel, as I post a lot of short content which I think you might find valuable about things related to personal finance, investing, the stock market, debt management, and housing. Kind of like your one-stop shop if you just want to get up to speed about the world of finance, just to make sure you make some good decisions. As always, really appreciate your time. I wish everyone has a great rest of their weekend, and ensure that you keep on taking steps to turn your rags into riches.